Got lots of hands up here
Hey
today.
Siam,
Good.
how are you doing?
Hey, good. Thanks. Yourself?
Yeah, good, thanks. You changed the topic of the room.
What was it? What did you see originally?
You had limited company or individual.
That's going to be
Also
later.
trader.
Yeah, that's going to be later on this week. The reason I think for the change is that I've got childcare issues at the moment. So I've got the eldest. Basically, my youngest son, he's 2 years old. He didn't go into nursery today, and so he's literally sat next to me playing on a tablet, and I'm just hoping that for the next half an hour he can be quiet. So I've had to bribe him with chocolate if he's
Good
nice
luck
and
with
quiet.
that.
Yeah. And so for the other topic that you mentioned, I wanted to spend some proper time talking about that. So, but yeah. Again, Starlink. Oh, I've just got an email today that Starlink is now sending their big old UFO on a stick to me, which is what they call it, as in the satellite dish, etc. So hopefully I'm going to have fast internet very, very soon. So I cannot wait, because on my iPhone here, I just keep getting errors going, limited connection, blah, blah, blah. Anyway, so we have a whole bunch of people here on Clubhouse. Thanks, folks, for being here. If you have any questions whatsoever, please pop your hand up. Today, I'm going to talk a little bit about rookie trading errors and then open it up for some questions. And who do we have here on Facebook? Hey, folks. And we have the usual suspects, which is awesome. So thanks for being here. Right, that's 12 o'clock. Let's crack on. And yes, today we're talking about rookie trading errors. So the things that I see all of the time, in fact, let's backtrack a bit. There used to be the old saying of the 90-90-90 sort of phase, and that's where 90% of people lose 90% of their capital in the first 90 days. And this is about retail trading. So the average Joe, you and I, learning to trade for the first time, teaching ourselves, etc. And that used to be the case for a long, long time. And that, although there's a lot of truth in that, it's not as bad as it used to be. I think when I first started trading, that was cool. About 2004, etc. I mean, Google wasn't really around properly. I mean, I remember Alta Vista. That's what I was using when I first started to trade. And I did the normal, in fact, I did what everyone else did. I Googled Alta Vista'd all sorts of, how to trade. I found all sorts of free resources, and I thought, this sounds really easy. Found some sort of dummy account. Tried some, bog standard moving average crossover systems, and I thought, this is really good. Did really well on dummy trading, and then like a week later thought, this is easy, I'm going to make a killing here, and then proceeded to lose money hand over fist for the next 4 years. And I guess I did all of the errors that I see everyone doing right now, and it's like a revolving door, honestly. In the UK, at any point in time, there's about 0.1% of the nation that are trading, actively trading. So I think off the top of my head, that's roughly 100,000 people at any point in time. And you have the solids, there must be a better word than that, but you have the solids. I guess you'd have probably 1,000 traders who are solid, who are consistently trading. So people like myself, I've been trading for years. I guess you'd also include bank traders, institutional traders, etc. And so they would be like the normal people constantly trading. So I guess there's roughly 99,000 people coming into the market, getting absolutely burned and rinsed, and then leaving the market over a period of time. And just because of the internet and all the adverts and stuff, it's a revolving door of pain. And it doesn't need to be like that. And so the error here is marketers, marketers ruin everything. And I say that in jest, because I've had to learn online marketing and everything for my businesses. It's the only way I grow businesses, through online marketing. And what happens is, whenever there's a medium of new attention, marketers flock to it. So, they're like, sweet, loads of attention, let's go to it. And so every new sort of social media platform out there, it could be TikTok, Snapchat, Facebook, whatever it may be. It's like, sweet, all the marketers plow in, and then they ruin the platform. And and that's where, you know, ads come up. And like Facebook used to be amazing in some respects, and then obviously everyone started Facebook advertising, myself included. And I guess from a marketing point of view, it's good and it's bad, because what happens is when everyone flocks onto it, the first year of a new platform, first couple of years of a new platform is like amazingly cheap ad spend, etc. And then the bigger boys come in with, you know, the bigger marketing agencies, and then before you know it, 10 years later, the blue chips go, oh yeah, we should probably check out that thing called Facebook and start advertising on it. And then boom, cost per lead, cost per acquisition shoots up, yada yada yada. And what happened in the trading space is something very similar. Like every new platform there is, like, or social media platform, there's 1,000,001 sharks advertising all sorts of stuff. And hell, you just need to look at my personal Facebook to see the amount of abuse I get. Scammer, 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 all that sort of bollocks. So, oops, sorry, darling. And yeah, they just teach all the same stuff. And so I say this, oh God, it's really hot in here. So for example, if you just Google chart patterns and then go to images, you'll see all of the same stuff. So you'll see the usual suspects, which is head and shoulders, double tops, double bottoms, dead cat bouncers, all that sort of stuff. And there's like a little cheat sheet. So if you want to trade a head and shoulders, you know, shoulder, head, shoulder, wait, draw the neckline, and then get in below the neckline, etc. But the thing is, all of these free cheat sheets online is the playbook to rinse the public. So if you're an institutional trader, and I used to be in a WhatsApp group with a whole bunch of bank traders, and that was fascinating, before they booted me out for being a retail pleb. Basically, I would shit you not, on this WhatsApp group there'll be a couple of Deutsche Bank traders, some Goldman traders, and they're mainly, was it JP, I think? It was either JP Morgan or Morgan Stanley, I can't remember. And there weren't many traders, it was like 20 odd traders. And it would be highly illegal, but basically you'd see all of these bank traders chatting because they're mates, because they get pissed with each other because they're all in the city, that square mile of corruption in London, and you know, they all know each other. And so every morning they'll be like, right, how are we going to screw over the Muppets today, folks? Or what are we going to pounce on today? And so there would be collusion between banks, not that the CEOs knew about it, or probably did actually. And so they would, you know, oh yeah, let's go hard on cable today. And then all of a sudden you see, you know, massive rallying on cable, and then it would be like towards the end of the afternoon, go, yeah, let's cover our positions now, let's exit. And then you'd have a full reversal. And guess what happens? All of the day traders, all the retail public like you and I, go, oh, cable, oh, pound dollar is rallying, let's go in. And because, I mean, especially if you're looking at the 5-minute chart, there would have been a massive rally. And so the retail market comes in, go, oh yeah, the trend is your friend, let's go long. And then guess what? The big boys exit, and everyone's left holding their, yeah, just stood there with their, yeah. So it's rather fascinating what happens, and this is why a lot of people lose. And the other reason a lot of people lose is because of IB agreements. So this is something which didn't make me a lot of friends in the past, because an IB agreement is introducing broker agreement with a trading platform. So. And it used to be pretty crap back in the day, before legislation sort of changed it a bit. And so if I was a scammy day trading trainer, so teaching, or just a scammy trainer, what I would do is have an IB agreement with a broker. I would get loads of people onto that broker. So not only would there be like a small lump sum sort of kickback, which is normal. Like there's all sorts of referral, affiliate schemes. I mean that's not bad, having a referral element. But the bad thing is that they would then get a percentage of the commissions and spreads per trade. So for example, the average day trader generates about £10 in commission per trade. Okay, and with the old IB agreements, there would be 40% kickbacks. So if I was a scammy day trading trainer, I would get, Joe Blogs, hey, join this platform, this broker, And then I'll teach Joe Bloggs how to do really fast moving trading, like trading on the 1 minute chart, 5 minute chart, so that Joe Bloggs would then start generating loads of trades per day. And I would get back in the day, you would get 40% of that commission. So if Joe Bloggs placed, 10 trades in a day, that's £100 of commission generated. The trainer would get £40 of that. And so, of course, the whole world of marketers went, oh my lord, this is like an amazing income stream. Let's just teach a whole bunch of muppets how to day trade on the 5 and 1 minute chart. They'll generate loads of commissions, and it doesn't matter if they lose all their money in the first 3 months, because they would have made an absolute truckload. And I'm being very pessimistic or conservative when I say £10 per trade in commission generated. So it's, and hands up, I've never had one of those IB agreements. So I've been with FXCM, which is my broker, for about probably 12 years now. And for about 12 years, they kept saying, hey, you got all of these students, do you want an IB agreement? I was like, nope, no, nothing, not at all. Yes, darling. Yes, sorry, the tablet game has stopped. Here we go. And so I've said no. And it's only, so this is where my hand's up, it's only in the last, I guess, few months that I've had just a normal referral plan with FXM. So I don't get any ongoing trade commission, because that's just incongruent. It's just if you refer someone to, I don't know, eat at a restaurant, and the restaurant gives someone, 10% off their next meal. It's a bit like that. So I get a tiny amount, if just a lump sum. So, bye Anna. So so that's one thing. And then there's all sorts of other scams, which they seem like they're popping up a lot at the moment, but they're not. It's just the same scam in a different frock. And I guess I've been trading 16 years, I've seen every scam there is. So the one that always rears its ugly head, or a lot these days, is binary options. And every time I hear someone doing binary options, I just a small chunk of my soul dies, because, and I don't know how they do it, because those that do binary options become obsessed. They become not like a Mormon, but like a Jehovah's Witness, and they're like, no, binary options is amazing. And so for those that don't know what binary options are, it's basically placing typically 30-second bets on the market. So they made it really simple, especially with tech and stuff these days. They've made the UI, the user interface, so simple. And they'll have a little chart, it could be of anything, Tesla or the FTSE, and there'll be a little, the market will be jumping up and down, and I don't know, you could set an amount to bet, you bet X amount per trade. And there'll be two buttons, it'll be up or down. And so there'll be a price of, let's say, 100, and then you have to bet whether the price will be above 100 or below 100 in 30 seconds time. So this is gambling, it's not trading at all. It's absolute gambling. And so people are placing all these trades, guessing if it's going to be above 100 or below 100 in 30 seconds time, winning and losing, etc. And the problem is that with some of the platforms, you can snatch profits. So let's say on a trade you're risking 100 quid. And that if you wait to the end of the 30 seconds, there's normally what's called a 0.7 risk to reward ratio with that. So what this means is that with most trades you'll be risking 100 quid, but the maximum, if you call it right in that 30-second thing, you'll make 70 quid. Okay, so it's a less than 1-to-1 risk to reward ratio. Now, the problem with a less than 1-to-1 risk to reward ratio is that you need your hit rate to be rather high. And annoyingly, I don't have a little doodle thing here. It would be cool if I could just draw on the phone. But it's like a curve like this. So, for example, if you risk £100 and win £100, that's what's called a 1R trade. In order to break even, your hit rate needs to be 50%. Okay. 50%. If, off the top of my head, if you had a 2R, so if you won £200 for every winner and you lost £100 for every winner, so a 2R trade, that means you would need, I think off the top of my head, something like a 37% hit rate just to break even. and then it goes down and down and down, to the point where, like, if you're doing 3R trades, you only need to be correct something like 25% of the time to break even. Well, no, 3R, you need to be correct 33% of the time. Sorry. Sorry. There you go. Now, the thing with binary options is you can snatch profits. And so what happens is people, they a lot of the time, they don't wait the full 30 seconds. The moment the market goes up a tiny bit, like snatch. So they'll be risking, £100 per trade, but then snatching, 10 quid. They're like, oh, 10 quid up, snatch. And they go, oh, yeah, this is amazing. This is easy money. Snatch, 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 snatch. But the thing is, with a 0.1R, so with a risk to reward ratio of 10 to 100, so 0.1R, you're basically guaranteeing you're going to blow up your account. Because what happens is that, yes, basically you need to win 10 times in a row just to break even, basically. And with trading, you will 100% have 10 losing trades in a row. You'll have 15 losing trades in a row sometimes. And I don't want to get into the maths, but mathematically, it's impossible to win with binary options. Mathematically impossible to win over a long period of time. You could fluke it. You could get a lucky week, a lucky month even. And a lot of people say, oh, no, I'm going to use proper trading methods here. But really, proper trading methods to win a 30-second guess? No one knows what's happening in 30 seconds. So what then people do is go, right, okay, I'm gonna add some filters into this. So I'm only gonna go long, so I'm only gonna bet that it's going up when we're in a really strong upwards market. And guess what? They'll probably do well for a week, a month maybe, but yeah. And so binary options, if you know anyone that's in binary options, just run a mile. I've got a hand up here in Clubhouse. Hey Adam, you have the mic, sir. Well, the little cog. There we go.
Hi, mate. Just keep going, and I'll ask you a question in a moment.
Oh, fair enough. I've stopped talking about binary options now. I was about to move on. What was your question?
Okay. So you send out to, or one of your team does, to anyone who signs up for the trial or whatever through the Realistic Trader, you send out your pop art book or whatever the updated version of it.
Yeah.
Like I think it's like 15 biggest mistakes you've made or whatever, something like that.
Yeah.
I can't remember the title of it. But, and it's all very much focused around Forex. So foreign exchange currency pairs, which is cool. But there's a lot of people who are involved in equities, particularly stocks, over the last 12 months. So the question that I'd have on this is, do you ever have two algorithms or two theses that you might be operating? So I'll give you an example of this. So there's a friend of mine who can't give any financial information at the moment with regulated equities that I play Age of Empires with, and he exited Tesla recently.
Yeah.
And I didn't. But the fundamentals are so strong of that company, I was like, I don't actually give a shit because it doesn't matter. I know it will come back, and it has come back. So I was like, it didn't matter. So do you ever have like two outcome scenarios? Like if one doesn't occur, you go, that's okay because the other one will trigger based upon that. Do you understand what I mean? Does that make sense?
I think.
It's a bit of a curveball question, but I'm saying is where you sort of talked about binary, which is like you either win or lose. It's like a complete gamble.
Yeah.
Like that. Do you ever have situations where you go, well, if this doesn't happen, then that can occur? Where you talk about rookie trading errors, it's not always so straightforward as such for some people. Do you get where I'm going with it?
I think so.
I've explained this in a car crash way.
I think I understand. Basically, you need different methods for different pots for different assets. You cannot have one.
Yeah, that's what I was trying to get.
So you absolutely cannot have one strategy for every asset, for every time frame, for every pot of money, because what will end up happening is that one pot will do really well with a certain asset, and everything else will be crap. So it's like taking Lewis Hamilton and going, right, Lewis, you're amazing at racing, and then he goes, yeah, I'm really good at racing, and then putting him in every vehicle, yeah, and then he'll just go full on race mode in every vehicle you put him in. No, that's a really bad analogy. I guess it's a bit like martial arts. You have different. Sorry.
Asked you.
Sorry.
I didn't answer the question particularly well.
Oh no,
I didn't
no,
answer the question particularly well.
It's fine. So let's take martial arts. So I've been doing martial arts since I was like 6 years old, and with martial arts, you have a whole array of different situations that you could end up in, and you have lots of different techniques that you could do. So you could, and like, so when you're practicing, you're training with a friend or whatever, and you're doing some light sparring, that's a method in itself. So you got your pads on, you're doing touch sparring or whatever, and that's a skill in itself, and you can become really good at touch sparring, but then crap in real life fights. Then you got all sorts of, you got real life street fights. So you could be, you know, in fact, street fights are different as well. You can have pub brawls, so, you know, kick out time at 2 in the morning and everyone starts brawling on the streets. That's a different type of fighting to if you're walking alone down the Uxbridge underpass in London, which was freaking dodgy, and I used to live in Uxbridge whilst I was in the Air Force for a bit. And then all of a sudden you've got 4 blokes chasing, like walking behind you and then chasing you. So that's 2 completely different scenarios. And so you have to use different fighting techniques in each scenario. You can't do touch sparring if someone's about to stab you in the Uxbridge underpass, which happened to me. Thankfully I didn't get stabbed. So so there's lots of different methods and strategies you need to use. So for example, bringing this back to trading, it's a very tenuous example. Let's take a very fast moving day trading strategy. Not that I day trade, I can day trade, but I just hate doing it. It's not a good leverage of your time. So it's like trading the 5-minute chart on, you know, a currency pair, which, you know, let's say it works for you, but then trying to apply that to other currency pairs or other assets. It could be crypto, it could be Tesla, it could be whatever. So for me personally, I have lots of different pots. So, and you don't have to, I'm not saying you should copy what I do. What I do works perfectly for me, and everyone else is different. So let's take trading. So I have a safe, I wish I could draw. So, okay, I'm just gonna use my fingers and my hand here. So my first thing, my thumb here. So this is my trading, my safe trading. So I have a trade, like a currency account. So, and I trade the currency markets. And this is my safe account. So of my trading pot, of my currency trading pot, 90% of my capital is in that pot. And I use a certain amount of methods which are very safe, they're very boring. The ROI per year is going to be, you know, anything from minus 10% to plus 20%, really boring, okay? Then again, still in the same market, still in currency trading, I then have my aggressive account. So 10% of my trading pot, my currency trading pot will be in this account, where I'll be going aggressive. So this is where I'll be using all sorts of, you know, using fighting analogies. I'll be kicking the balls, gouging their eyes out with my thumb, aiming for the throat, shin kicks, all that sort of stuff. So that's, yeah, and so the potential ROI here is anywhere between minus 100% to plus 100%, you know, in a year, depends. And this account I blow quite a lot. So I'm very, as I said, it's my gambling account, my aggressive gambling account. So that's just my trading. That's just my currency trading. Then I've got an ISA, which I've maxed out. And with my ISA, I'm really not fond of ISAs. So I've just plonked a whole bunch of money there. And that's just my Tesla money. So all the money in my ISA is really, that's just dedicated for Tesla to buy and hold. Having said that, I'm currently doing something a bit different at the moment. I'm currently I've got my ISA money in a thing called ARB, A-R-B, which is like a Bitcoin mining type tracker thing. And what I found is that with ARB, it acts as a lagging indicator for Bitcoin, or vice versa. Bitcoin is a leading indicator for ARB. So what happens is, when Bitcoin goes up, a day or two later, ARB then goes, oh, yeah, okay, I'm going to start rising. So ARB then goes up. And then when Bitcoin reverses and starts falling down a bit, a day or two later, ARB goes, oh, yeah, let's follow Bitcoin down. And so I've been using this sort of arbitrage for probably about at least a month now, not too long. And so all I'm doing is I'm just maximizing the profits with ARB and doing the up and down with that. and then eventually I'm just going to plop all of that profit over into Tesla, and then sit and do nothing and just forget about it. So that's my third pot. My fourth pot is my SIP, which I really do not care about, because you can't touch your SIP money for freaking years, until I'm old and crusty. No, not old and crusty. What am I talking about? You're not old and crusty when you're like 65, 70. So these days it's still relatively young. So all the money in my SIP, I've actually just put it in an Ether tracker. Now you can't do that anymore because in the UK they've banned the selling of crypto derivatives. So other people have got around that by trading, playing with ARB or whatever. But heck, I could just dump that in Tesla. So my ARB and my ISA and my SIP, I'm really boring. I just do nothing with. So that's 4 pots there. I've got another pot of gold and silver. So that's physical coins and bars. Oh no, wrong jeans. And so what do I do with that? Nothing. Buy, hold, forget, come back in X amount of years. So that's, I guess, my 5th pot. I've got another pot, which is my, so my cryptos, so the Kryptonian portfolio. Now in that crypto pot, that's lots of little pots in the whole crypto pot. So even in my cryptos, I'm doing different things. So I've got a whole bunch of cryptos which I'm staking. So that means I've parked it and it's just generating a yield, 5 to 20% per year, APY roughly. Not APY, it's yield really. So that's one pot of my cryptos. I've got another pot which is like my punts. So I am sort of trading in and out of that sort of stuff. I've got another pot of crypto where I guess they're my safer punts. So they're like the blue chip crypto. So, Cardano, Ethereum, Chainlink, Polkadot, Gas. Oh no, that's not. What else is there? Binance, and a few other bits and bobs. So even in the crypto pot, there's lots of different pots.
This raises another question.
Yeah.
To be fair. This raises another question, which is quite easy. By the way, I know that underpass. I went to Brunel University. I guess you went to RAF Uxbridge.
Yeah, I was based at RAF Uxbridge.
I didn't do martial arts, but I could run. Yeah, I didn't do martial arts, but I could run very fast.
And that's a good tool.
Yeah, I know what you mean.
Yeah.
Yeah, it was. The question what you've raised by going through these, I think it's useful for everybody, because everybody's here for, I think, the same reason, is how do you get started? There's so much misinformation, disinformation. Everybody's just trying to take your money off you, to earn a quick buck, to teach you whatever that they want to sell you what you want to hear. Where's the best place to get sensible knowledge from? Plug whatever you want to plug. Because you've got to start somewhere. It's different. For example, if you go into a bank, they're likely to sell you what the bank offers for sale, their products.
Yeah.
Where's a good place to start with all
I mean,
of this?
just a quick tangent, yeah. Talking to a bank IFA is one of the worst things you could do. A bank financial, I don't know if they still do it, but a few years ago I went into Santander to open up an account, blah, blah, blah. And they sort of scurried me over into a room to talk to the Santander financial advisor. And I was like, well, okay, I'll just went along with it. And I started acting dumb and just seeing what they were having. And basically I just wanted to see his sales pitch. And they were trying to sell me Santander related products, blah, blah, blah. And I was like, okay. And then I started asking a few other things. And I was like, well, what about this? What about this? What about this? And the guy couldn't sell other stuff. So literally the only thing he was selling was Santander related financial products. And I'm like, this is so incongruent, because some of the things you're promoting are pants, 2% yield, stuff like that. So, and it seems as though you've been paid to ask this question, but honestly, Adam is not being paid anything. The best reason.
I haven't.
Seriously,
I wish I had.
Yeah. Seriously, the two things you could do is, one, check out the WAP, thewap.org, because that'll teach you all sorts of generic stuff. But for trading and investing type stuff, just check out The Realistic Trader. There's a 2-month free trial and you get access to pretty much everything. So shameless plug, because it's genuinely good. You get 25 hours worth of videos and live sessions every week for free for 2 months. Thanks for that, Adam. What was I going to say? Different pots for different people. Yep, that's that. And ultimately you need a bullshit detector, and you don't have that. You just don't have that when you start something brand new. And I've had to go through the ringer to learn all of my stuff. In fact, I think tomorrow or another day, what I really want to talk about is scams in business, and because I've been caught up in some scams. In fact, a financial advisor got me into a scam. So this is what 2010. So this is when I was doing BNI and 4 networking, and I was, you do those breakfast meetings, etc. And there was a financial advisor, a proper, financial advisor, and he stood up, did his 1-minute pitch, and went, "Hey, if you've got a credit card or some credit card debt, I can get rid of it for you for £1,000." And I was like, So there was me with, I think, £4,500 pounds in an MBNA credit card, going, "This sounds interesting. So I pay you £1,000 and you get rid of £4,500 of debt. Okay, I'm all ears. Pitch me." And so he was very convincing. We had a one-to-one meeting, and at another date, I was like, "Is this legit? Seriously?" And I was like, "Yes, I'm a financial advisor. I work for this company called Card Light. Feel free to Google Card Light, absolute buggers." And yeah, so what happened is I ended up paying this IFA, who is like an affiliate to Card Light, £1,000 plus VAT, so 1,200 quid, and then had to fill out 1,000,001 forms. And I think the way he did it is like, there's this loophole. What happens is that you sign away all of your debts to Card Light. Card Light uses this loophole, gets rid of the debt, boom. Fast forward, I filled out everything. I then had like a month of phone calls from MBNA saying, "You can't do this," and harassing me. And I was told, just ignore it, so I did. And then I got a letter saying, "Yep, your debt is now signed over to us. Thanks for your business. You're now clear. You have 0 credit card debt." I was like, amazing. So yeah, this was like 11 years ago. And then I heard nothing, absolutely nothing for 6 years. And then what happened, 6 years later, I moved house. I wanted a credit card because I didn't have any credit cards. Signed up for a Virgin card. And then it must have pinged something, because what happened is that MBNA was like, "Oh, Siam, there you are, found you." And then sent me all sorts of debt collectors after me. I was like, "You owe us £4,500 in debt plus interest." And I was like, no. Card Light has that debt. And it turns out Card Light was a scam, and it scammed thousands of people. And then what happened is, due to that, in 2016, they put a black mark on my credit score because of that whole thing. And I was like, no, this is like so on my credit score thing, there is a black mark that I've defaulted on a debt. And I didn't default on a debt. I thought I was doing a legitimate thing. Evidently not. So knowing who to trust is hard, even if someone's got like 1,000,000 letters after their name. I mean, hey, there's all sorts of doctors with millions of letters after their name that you can't trust these days as well. So so Mark Sparky Martin said statute barred after 6 years. What do you mean by that? As in, are you saying that your record is cleared after 6 years? Well, I think that is the case, but the black mark was then issued in 2016, so I've still got that. If I look at my credit score right now, it's pants. And I think it's just because of that. I don't know. So yeah, it's hard. In fact, half an hour is not enough to talk about trading scams. We barely asked. Yeah. In fact, let's stop that. Let's talk. I said this would be a Ask Me Anything. So if you have any questions whatsoever, pop them in the chat. Anything about trading. I'm scrolling through the Facebook feed. Okay, so Eddie Cochran said, "I'm looking at the option of buying shares in a company that I know is going to skyrocket. It's 70p per share just now. How long would you hold them for, as I know this will quadruple within a year?" Okay, so the first thing I would address is your confidence or overconfidence in that particular stock. If I were to be able to rewind time and claw back all of the money I've lost from sure bets or sure things, I would be much richer than I am right now. So the first thing I would address is, why are you so confident that this company is about to skyrocket? Now, if it's insider knowledge, then you've got to be even more careful that you're not trading on insider information, because that's illegal. So yeah, you have to understand, like, wonder why. Now, if there are genuinely strong fundamentals, then I would play the longer run. Remember, the longer that you're in something, the higher probability that it will rise. Especially when we're in a world of, quantitative easing and currency expansion, that, over time, asset prices will go up. No shit, Sherlock. So this is why, so if it's, and again, Eddie, I don't know what your pot is. I don't know how old you are. I don't know what your risk appetite is. I can't give financial advice or information. And I don't know what pot of money in your investment world your money is going to be in there. And what I would personally do is probably not palatable to a lot of other people, because what I tend to do is that when I get to a certain level of confidence or if not certainty in something, I bet the farm. So this is, I think, one of the things that separated me with some other traders and investors, that is that, yes, sometimes I have some big hits. I think, like oil has been smashing me about for the last year and a bit. However, my winners have been far larger than all of my losers combined. If you took every losing trade or investment I've ever done, and combined to my winners, the winners dwarf it. And that's because when I get to a certain level of confidence and certainty, I don't just put 1% of my account into a trade or 10% or whatever. I bet the farm. And I guess my stop loss for that is that I have a constant income stream. So I've got businesses that will replenish my purse, as the richest man in Babylon would say, replenish thy purse with a constant stream of monies, I think he says, or something like that. So that is effectively my stop loss, so I can recover, whereas a lot of people couldn't recover. And so I do swing for the fence. So for example, the things I'm really swinging for at the moment are crypto and Tesla effectively, or crypto basically right now, because I have a very high level of confidence in it. And if I'm wrong, what will I do? I will automatically default to being a hodler. Simple as that. So my crypto, I'm not using margin. And so if I am wrong, and you will be wrong over the years, no one has a 100% success rate. You'll just become a hodler. And one thing we know for a fact is that we will always be in a world where the central banks and governments will just print, and so asset prices will rise over time. That's why people have a false confidence in, my house has doubled in price over the last 15 years. Well, yeah, because there's more money sloshing around. So that's that. And don't forget, even the most credible people on the planet are wrong. So here's an interesting thing that always stays in the back of my mind. Albert Einstein, one of the greatest minds to have ever lived that we know of. He was a rock star. He was the Elon Musk of physics and theoretical physics and astronomy. Well, towards the back end of his career, he predicted and said 3 things which were proven to be catastrophically wrong. Not many people know this. So towards the end of his career, when I guess he was cruddy and old and crusty and whatever, he said that black holes don't exist. He said that gravitational waves don't exist. And he said that, what was the third one? It's basically something to do with quantum mechanics, and that when observed from a distance, they don't do quirky things. And those 3 things have been catastrophically wrong. They've been proven all those 3 things exist. And that's Albert Einstein, who, you couldn't get it more wrong with those things. But that's the thing, when you're, especially with physics, and when you're doing things on the frontier, so things that, black hole, studying of black holes, particle, quantum mechanics, all that sort of stuff, that is the frontier of science. So you will be wrong. It's just impossible. The amount of people that said that, the Earth doesn't orbit a star, or our sun, etc. And that same sort of stuff, that analogy, comes back to investing. You see so many financial advisors, investment planners, hedge fund managers that you go on CNBC and they talk the talk. They look, oh my Lord, I want to put all my money with that person because he's amazing or she's amazing. And then guess what happens? They shit the bed. And with the bed, they shit your money. Sorry. So Eddie, that's a really long answer to your question. It's probably not the answer you wanted. Sorry, mate. David, hi Siam, what's your view on Celsius? And could you explain the benefits and cons? As I understand, you could take a loan against your crypto portfolio, then potentially use that to purchase additional crypto. So I've used Celsius. So when I was checking out all the crypto lending platforms, Compound, Celsius, Aave, Mako, and all that sort of stuff, I put loans in with most of them. But Celsius, I ended up bailing last minute because what they're doing is they're using a current model in a crypto world. So what is the current model of lending? It's like, okay, you ask someone for money, you have to fill out a whole bunch of forms, it then goes into a review and someone deems whether you're worthy or not. And so when I put in my Celsius loan, I deposited a whole bunch of crypto in Celsius. I wanted to borrow 20% of what I deposited basically. And then it went up for review. And it was like, we will contact you in 2 to 3 working days. We're like, well, and I mean, yes, they have no fees on Celsius, but it's like, what? A human has to review my loan? Well, why? I've got all my collateral put up there. There's no risk to you. And so I was like, chin this off. This is rubbish. They've got to pivot their model quickly if they want to survive in this world. And then compare that to Aave. So Aave, I've done a whole bunch of different loans on Aave. I borrowed, like, the last one I did, I deposited 75 Ether into Aave, and then borrowed, is either 15 or 30 Ether. So I think, yeah, I plonked like $120,000 in Aave and borrowed, I don't know, $30,000 in Aave in what, like 2 minutes. No one had to review it. You don't need to, because you're stumping up the collateral if anything goes wrong. So Aave is a much better platform, other than the freaking fees. You absolutely get rinsed on fees on Aave. So in and out, probably between $300 to $700 in fees, which is nuts. So if you're doing any of these crypto loans, you need to be in there for a while. Oh, and don't borrow Ether. Borrow a stable coin. So the thing is with Ether is that I was all right because I put it into other stuff, but where I see a lot of people go wrong is that they will probably dump a whole bunch of Ether onto the market, or onto Aave, or any lending platform. They'll then borrow Ether, and let's say Ether is at $1,500, okay? And then they'll just sit there and do nothing. And let's say a year passes and Ether is now $3,000. They're like, ha, sweet, I borrowed a whole bunch of Ether and it's now doubled in price. But guess what? You owe 15 Ether you owe that Ether as that loan. So you've made no money. You've made no money. So yeah, Ether may have doubled in price, but let's say you borrowed 10 Ether. It doesn't matter if it goes up or down in price. If you have to pay that 10 Ether back. You're not paying back in dollars, you're paying back in Ether. So if you do borrow in Ether, what you need to do is then convert that Ether into another crypto, and you've got to hope by jelly that whatever you then invested in appreciates faster than Ether. So I think I personally wouldn't borrow in Ether, because Ether is about to, honestly, it's about to moon. Honestly, I am so bullish on Ether right now. It's ridiculous. The rallying we've seen in Ether isn't anything what's to come. It hasn't got started yet. And by the way, I can say this because crypto is not a regulated asset, so I can literally say go and put your life savings on Ether, and that'll be fine. I'm not saying do that, by the way. So yeah, David, that's my thoughts on Celsius. Adam, yeah, what thoughts, mate?
I know you love talking about the cryptos and those things as well. I just wanted to pull it back slightly to the topic that you had today.
Yeah, sorry.
It's cool. Just excluding day trading, what would be your 3 rookie trading errors, that like the worst ones that either you or other people, like the ones that just put people off for life?
Nice
what
one.
Were the 3 that you'd come up with?
So first of all, you are an amazing compare. So I need to pay you to be here every day to keep me on the track. So the first one is leveraging. So over leveraging. There's 2 ways of over leveraging in trading. You can either place too many trades, or you can bet too much money per trade. Now, the latter is the one that kills. It's where people go and they risk too much. and they'll probably see a video of me going, only risk 0.25% per trade, and they go, what? 0.25%? And so what is that? What is 0.25% of £5,000? I think that's what, £12.50? I think. I'm hoping there's a maths bod here, but yeah, let's just say it's £12.50. So you have a £5,000 account, and what I'm saying is if you have a £5,000 account, you need to risk £12.50 per trade. And then there's newbies going, that makes no sense. I'm never going to make any money by doing that. But the thing is, with trading, the less you risk, the more you win. And so what I see all of the time, and no matter how many videos and how many warnings I do, this is what happens. People go, I see what you're saying, Siam, but I know a little bit better. And instead of 0.25% per trade, I'm going to risk 5% per trade because I want to make a bit of money here. I don't want to make like no money. And then what happens is a week later they go, oh, Siam, I've accidentally halved my account. I was like, okay, how do you do that? And yeah, it's because they were going in at 5% max risk per trade, and they lost 10 trades in a row. Guess what? They lost just under 50%. And then once you've got to minus 50%, you then need to make 100% just to get back to break even. So over risking or over leveraging is the biggest killer. What is the second biggest killer? The second biggest killer is strategy hopping by far. They're like, everyone's looking for that holy grail trading system. They'll find something, they'll do it for a week or a month if they're lucky, and they'll go, oh, this doesn't work, let's look for something else. And what they don't realize is that you need, as I think I sort of said earlier, you need the correct trading strategy for the correct market and market condition. So if you look at, for those, in fact, I mean, you'll know this, Adam, but for those who are not familiar with trading in my community, there are 6 types of market. People think there's up, down and sideways, but there's not, there's 6. So you have a volatile upwards moving market, and you have a volatile downwards moving market, but you then also have a steady, nice orderly upwards moving market and a steady downwards moving market. So that's 4. And then you have a volatile ranging market, so massively up and down but just going sideways and going nowhere, otherwise known as NDV, non-directional volatility. And then you have steady ranging where the market is just flat. So that's 6 different market conditions. And so if you try and teach yourself how to trade and find some crappy system on Google and then go, oh yeah, this looks good, this good old moving average or Bollinger Band thing or whatever, what happens is the newbie tries to do that in all market conditions. And what they may have learned and taught themselves is like a steady trend trading system. And then all of a sudden they're trying to execute that system in a choppy market, a choppy ranging market, or a volatile bull or bear market, and they get absolutely rinsed. Or if they're even worse, is that they'll be lucky. So straight away they'll start trading that system in the correct market condition for a month or so. They go, oh, this is amazing, I've made X% per, I get this all the time, I've made 20% this week. I'm like, oh, the first one, if anyone makes 20% in a week, they've risked too much and they're over trading for sure. But then what happens is they go, oh my God, this system's amazing. And so they over leverage, they add more money into the market, into the account. And then guess what happens? The market condition changes. It goes from a nice steady trend to a choppy ranging market, and they get absolutely whipsawed. So that's the second one. So what is that? Over leveraging, strategy hopping, logging. And this is what no one wants to hear. No one wants to hear logging. It's like the most boring thing on the planet. It's like people get into business. They're like, oh, I've got this really good business. I want to set it up. I want to sell this product, and this thing is going to be amazing. But what is the one thing that all business owners hate doing? Accounting. Ugh. Literally, looking at your business metrics, going through your profit and loss, going through your bank account statements, all that sort of stuff is really boring, and all business owners hate it. Me included, I hate all that stuff. And it's the same with trading. If you do not log your trading and you're not consistent in your logging and your execution of a system, it is impossible to succeed on the markets. And I can say that. It is impossible for you to win on the markets in the long run if you do not have a set system which you then execute flawlessly over a period of time, a minimum of 100 trades and a minimum of 1 year. So you then have a sufficient data sample, and that you've logged every single trade, even if it's a losing system. And because the holy grail of trading is in your logging. So put it this way, I could pluck out a random system out of my arse right now, and and let's say it's a losing system, okay? So what I could do is I will then execute that system for a year and generate at least 100 trades, minimum of a year. And so a year later, let's say it's done 100 trades over a year, and it's been losing. It's been consistently losing. So I know over a year, because I've risked very little, 0.25%, let's say I'm only 5% down, okay? So a lot of people go, well, this is such a waste of time. I've been logging every single trade. I've got 100 trades perfectly logged. Every trade just loses or whatever. It's just a shit system. But once you have all of that data, you can do a few tweaks and turn it into a wildly profitable system. Wildly profitable. And that's all you need to do. You just need to tweak a few things, because all you do is you analyze all of your winners, and then the two questions you ask yourself with the winners is, how can I make more, and how can I make more from these winners, and how can I increase the frequency of these winners? You then look at all your losers and go, okay, how can I reduce the amount I'm losing when I do lose, and how can I reduce the frequency of losses? Okay, so they're the questions you're asking when you're looking at your winners and losers in your logs. And then through trading metrics, which this is too long to explain right now, you can then tweak a little thing. It could be the size of your stop loss, and then all of a sudden it's profitable. Or you add in a filter and you realize all your losing trades are because you've entered in, on a surging market or something. So there's all sorts of things. Just like in business, there's 1,000,001 metrics and things you can tweak to make a system to make your business profitable. Same with trading. So I guess they're the three. Let's quickly look at. So Julie Jordan has said, "Where do you stake Ether? You can stake it." I've been a bit lazy on that. I've actually. Oh no, I'm not even staking my Ether. I've staked a lot of my stuff on Binance. So on Binance is just a couple of clicks. So. Not that I would recommend it, because you're then parking your capital on an exchange, and there's exchange risk. It could be hacked. It could go bust, and all that sort of stuff. And I don't stake Ether, because with Ether 2.0 and the staking, the yield is pants, maximum up to sort of 9%, and that's going to deteriorate over time. And you're locked in for a long time, and so I just don't stake Ether. Raheem, have you looked into a SaaS? Yes, seems to have quite a few benefits over a SIP. Yeah, have both. You need a SIP for yourself, and you need a SaaS for your business. If you're a director. Looking at the questions. Okay, no more questions. Hey, Stefan, long time no see. I know that's not your real surname, woo-woo. Any questions here on Clubhouse? Again, this is another 30-minute chat that's rolled over into 51 minutes so far. Any last questions? I know there's a lag here on Facebook, so I'm just giving it a few seconds. Cool, right, that's it. Big round of applause to my 2-year-old son here, who's been absolutely silent. I've managed to just get him on a tablet. And Romy, you need a lot of chocolate now. You've been a very good boy. So I'll see you all tomorrow at 12 o'clock. And I don't know what topic it is tomorrow, but it's going to be fun, whatever it is. See you at 12 tomorrow. Thanks all. And Adam, you're a legend. See you on Age of Empires later for a spanking.
Yeah, all right.